What's up, everybody? Sean from Invest to Live here, and today we're going to be talking about bear traps. So, yeah, there's bear traps in the wild, and that's for the grizzlies and the black bears and the brown bears and trying to keep them out of your backyard, but this is a little bit different of a bear trap. So, what we're talking about is a bear trap in terms of movements within technical analysis that can be deceiving at first glance and oftentimes can catch retail traders really by surprise. And the key question is not only how do we recognize them and what are they, but also, is there a chance that we're being manipulated as retail traders into thinking things are going down when they're not? Let's dig into this just a little bit today. So, first and foremost, just to set the stage, a bear trap is really representative of a technical pattern in technical analysis. And what happens is a price of a stock, for example, and it could be any asset class, index funds, REITs, really anything, futures, equities, currencies, bonds, it doesn't matter, right? The type of asset class is not important. But what will happen is it'll incorrectly signal a reversal from a downward trend to an upwards trend. So in theory, what will happen is we start to think that a position's moving down, and we quickly have to react and say, well, what are we going to do? And so maybe we dump all of our shares. We start to try to take a short position or put a put on, right? So we can get access to that downward move. But what happens is oftentimes this is a trap because as soon as you get into that position thinking it's going to move down, it reverses back up again because it's very easy to misread bear traps in the world of technical analysis. Now, here's the thing that's really interesting here. The reason I wonder often if this is sort of a little bit of retail getting beat up by institutions, here's why. When you're moving large amounts of capital within the markets, you have teams of technical analysis professionals. They often can see level 2 quoting. They can see the stops and limits that are in the system, sometimes faster than you can see them. So there's a theory going around that a lot of institutional traders do this on a regular basis to set retail traders up so that you sell your shares out of fear of losing money. They end up buying them at that cheaper price to take advantage of it and ride it back up once they start buying again. Now, here's the way a bear trap is really going to technically work here. Now, I want to be clear. Depending on the financial instruments, the volatility, the action within the market, sometimes it can happen in different ways. It can be hard to identify. But when you know what you're looking for, you can get there. My general advice, though, of course, as always, is be careful, buy and hold, do the simple things. I also want to take a moment, of course, as always, that I'm not your financial advisor, and I'm not trying to give you advice here, but trying to bring awareness to these things that are happening. So oftentimes, here's the situation. We might have a really popular stock, okay? Let's take, I don't know. Palantir is a popular one. I talk about, a lot of folks talk about Palantir, right? So it's very popular, but there might be a lot of buying action. But then strange things will start to happen, right? So what happens is there can typically be lots of investors who want to buy, but not always a lot of sellers in the market, right? So it creates pressure on the price. So this is a situation where the buyers are going to have to start to amp up what they're willing to pay, right? The bid and ask spread might increase. And for me to get those shares that I want, my limit orders aren't going to execute unless I keep raising that price of my limit order. And this starts to create more of an imbalance in the price and an imbalance in the market and the fairness in the way that that bid-ask spread is working. And what happens is people on the other side start to see this. The sellers start to see this pressure that more and more people are paying higher and higher prices and losing value in that higher price. So this can be an opportunity where people have to start now selling more to catch up with all of those asks from those buyers, right? But the problem is, as those buys are happening, the seesaw starts to swing back or come back to the other side of being more selling pressure, because as all of those buy orders are filled, now there's more sellers in the market to sell it down, right? So it's really important to understand there's always an ebb and flow here. So what ends up happening in its simplest terms is if a lot of people start to buy the stock, it's going to start to take away that buying pressure. And then we get the reverse, which is the selling pressure. Okay. It's important to understand this with the markets. Now, one thing we can often do is recognize the fact that there are things that can happen here that aren't always obvious, right? So in the case of a bear trap, you, me, institutional buyers, whoever, we might expect that decline in the value of that underlying asset class. And what will happen is we'll take a short position or we'll put a put on in place. But now what can also happen just as easily is that can flatten out that pressure. We can see that nothing happens. The stock goes back up. There was too much selling in the market. And that's where the bear trap happens, is simply because we had too much pressure on those buys. We got that quick decline, but that decline got wiped out really fast, which sent us back up again. Now, the key here is recognizing these patterns and knowing what they look like. Excuse me. And I think that's the takeaway here as I'm thinking about this is we don't want to play games where we're trying to jump in and out all the time, not understanding the patterns, not recognizing what they look like. So there's lots of ways from a technical perspective that we can think about this, but I don't do technical analysis, and I'm not the right person to talk about this. What I do want to call out is I generally don't jump into markets until I have a conviction about what's happening, because I'm not a day trader. If you're a day trader, I hope that you're using technical analysis, looking at all the different levels of buy and sell pressure, and understanding where those limits are and when they start to stretch their extremes. When you see those things like that rising need for limits to keep going up, or that bid-ask spread widening extremely large, that's when you start to be worried about getting into these traps, because it can hit you real hard and hit you out of nowhere. Now, additionally, what can happen here too is if you're on the wrong side of this, you can have a situation where all these folks who suddenly started to take those short positions now have to cover those short positions. So a bear trap doesn't have to happen in a matter of minutes or hours. It could be days. It could be even weeks. So keep in mind that when all this pressure is put on those short sellers, they have to start paying for those shares, paying interest on the shares that are borrowed. If that suddenly sees an increase in interest in buying again, and those positions become more expensive, they're now going to have to exit those shares and buy those shares back. This creates even more accelerated pressure up. So what happens is, and the reason we call this a bear trap, is because you went from being bearish to now being trapped in short positions that you're going to have to take losses on potentially to try to exit those positions. So I want to give you just a couple of key takeaways here. In its most basic format, a bear trap is a technical indication of a reversal that is false from a down to an up market that can bring people into it misunderstanding the technical analysis that they've seen. Essentially, to put it simply, we thought things were going down, we were wrong, and now they're going to go up or accelerate up very fast. The market, class, asset, equity, FX, whatever that it's in, it doesn't matter. It can happen anywhere where there's trading. And oftentimes what we'll see is the initial warning sign of a bear trap is there is some sort of a decline that makes people want to go short or take short positions. And then we then quickly see a reversal of that move, where we then have to see the covering of those shorts or the dumping of those puts. So hopefully that was pretty clear. Sometimes these things can be tough to talk about, but that's a bear trap in a nutshell. And I wanted to share that today because I think right now in the markets that we're in, we see these things that are happening by the day, where we start the day going way up and then quickly come back down again. We start way down, but we jump right back up again. And it's important to understand that just looking at the price of a stock is of no value if you're trying to get in and out of positions. You have to understand what the demand is for the buying or selling pressure. If prices are going down, is it because there's a high degree of short selling happening, or is it just simply people selling their shares? There's a big difference in understanding what that is. Now, if you're a buy and hold investor, you don't have to worry about any of this stuff. You buy at prices you believe in, you exit at prices that you feel comfortable with, and you hold it in between. But if you're not, make sure you know these things. You know the pressure can create on your portfolio, and you know the way to not only be aware of the risk, but potentially even hedge against the risk and make profit on that risk as well. So as always, thanks for watching. I like doing videos like this, and this came in as a request. So if there's any more like this, please let me know. Thanks so much. Have a good rest of the day, everybody.